overview now to help us focus on the fundamentals behind the technicals. Ben Cook joins us, portfolio manager from Hennessy Energy Transition Fund. Ben, welcome. Good to have you with us. So we just looked at the recent price activity in the WTI rates, also a major focal point for traders this week. A pretty good example how tightening global crude oil inventories and rising geopolitical tensions, how, well, they underscore upside price risk. Sounds like you see this continuing into next year.
Yeah, obviously. First off, Ben, thanks for having me back. Appreciate it. Look, I think as you put it, geopolitical risks are front and center for investors and commodity traders. While we haven't seen any supply disruption yet to date through this Israeli-Hamas conflict, the likely and potential disruption associated with escalation or the involvement by Hezbollah or Iran could easily trigger supply loss. And in that case, we would see a much higher oil price. And I think as long as the risk to that supply loss exists, you're going to continue to see a risk premium embedded in the crude contract.
I keep hearing about this, the risk, and how it's one of the largest we've seen in decades, many would say, in terms of the complexity of the ongoing situation, the potential involvement from other players, the broadening involvement, basically. We're hearing about that is, to your point, the road to higher prices. But in many ways, I feel like we've seen that. I mean, overnight, last night, we had one of these U.S. carriers in the region having to down some missiles that were flying overhead, yet still all of this being largely discounted, to your point, more tied to the supply side of things, but Iran's involvement could change things.
Yeah, it certainly could. I think in a worst case scenario, we would see some sort of conflict which could put the Strait of Hormuz in peril. Obviously, the major choke point for the transit of both crude oil and liquefied natural gas. The Strait of Hormuz handles roughly 15 to 20% of daily crude demand on a global basis and about 1/3 of global LNG supply on a daily basis. So it is a very important strategically important geographic choke point for crude oil flows. And so I think any disruption, any signs of conflict or escalation which suggests that choke point might be at risk would certainly send commodity prices higher. And where that peak could be is a function of the extent of the disruption.
I'm reminded of what was it, the shipping barge that got run aground in the Straits there, and the disruption that created. I'd imagine a more volatile situation. Yes, would be quite the disruption to price activity at current levels. Let's talk a little bit about rates, because throughout the week we've been hearing a fair amount about the Fed and how the move up we've seen in this run higher has done some of the heavy lifting for them. I'm kind of wondering, has this move up in rates that we've seen, or the Fed's aggressive approach towards inflation, has this slowed crude demand as well?
To date, it's been interesting. We've actually seen a fairly healthy pace of demand growth, 2023 versus 2022. I think the rising rate environment's a function of a very healthy economy and very strong consumer. We did see a little bit of pullback here over the last several weeks on rising inventories with respect to gasoline, and I think some may have misread that as softening in demand. In our view, the consumer continues to be very strong. They are well equipped with cash, plenty of cash on the sidelines and in savings accounts. And, I think an underappreciated element here is the strength in the U.S. housing market. Their U.S. consumer obviously feeling very good about themselves with where home values are. And I think that'll continue to support, the amount of consumption and strength in the U.S. economy. For this year, we're looking at GDP rates, above 2% on a real basis here in the U.S. And next year, we should see growth as well. So as long as the consumer is strong, even with rising interest rates, we can continue to see a rising demand for transportation fuels and ultimately crude oil.
We've been tying that healthy consumer, the healthy economy into this strong labor conditions, tight job market that we've seen. Talk to us a little bit about how we've been discussing throughout the week with our viewers positioning in this volatile environment. And I'm curious how some of the changes you've made now that you've adjusted to reflect some of the current conditions.
Yeah, as part of our investment process in managing the Hennessy Energy Transition Fund, we're looking for companies that provide exposure to the most favorable trends across, the broad energy landscape. And Over the last 6 months, we've seen an improvement, a dramatic improvement in crude fundamentals, obviously, with the Saudis and the Russians electing voluntary cuts. We've seen inventories pushed into deficit on a global basis. That's given a bid to crude prices even before the events have unfolded here in the Middle East with the Israeli-Hamas conflict. So crude fundamentals and natural gas fundamentals, to that same point, have improved dramatically recently, and our positioning reflects that. We have a relative to historical standards, a fairly high weighting towards those companies that generate revenue and cash flow from the sale of the commodity. So think of the upstream sector, the integrateds, oil service names that are going to benefit from a continued tightness in the global commodity fundamental picture.
Ben, does this tip the scales one way or the other in terms of potential for a difficult situation for Europe come this winter? Should we see further, broadening of this ongoing crisis? Ultimately, you mentioned natural gas and the, passage that's necessary through the straits there as well. Ultimately, I mean, this is one of the things we were talking about last year. Europe managed to avoid a crisis, many called it or were predicting. I'm curious where they stand and what things look like as we head into the winter this year.
Yeah, while the events in the Middle East have certainly captured the attention of the marketplace here recently, the Russia-Ukraine conflict is certainly still on the front burner and should be watched very closely with respect to supply disruption into Western Europe. From an inventory standpoint, Western Europe is in a pretty good spot. They're about 98% full in terms of seasonal storage levels and inventory, so they're well positioned. But they're still dependent on roughly 15% of their gas flow, either through LNG trade or through pipeline, on Russia. And I think we just within the last several weeks we saw headlines out of the Baltic area, disruption in pipeline flows with a gas pipeline that connects Finland and Estonia. These are the kind of headlines that I think underscore the risk that continues to present itself to Western Europe as we approach the winter. If we have a colder than normal winter, prices will move dramatically higher. Natural gas prices will move dramatically higher as Western Europe scrambles to find additional supplies to meet shortfalls.
I ask because I'm reminded of last year how we saw the euro currency weaken quite a bit, right? Into the fall of last year, the dollar rallying up into that 112, 113 area amidst some of those concerns. It was weighing on the currency. Definitely, we saw that play out here. But I'm also asking because I also know when you're talking about commodities, the focus oftentimes is on the U.S. dollar. So again, whether you're talking about Europe, the tail that kind of wags the dog, as I like to put it, or the influence that the dollar has on some of these products, crude oil, for example, maybe not as much a factor as of recent, though, in terms of what we've been seeing with rates, as it's been kind of hanging out comfortably around 106.
Yeah, there's no question the real rate of interest here in the United States is attractive and has been pulling capital flows into our marketplace. I think, what happens with the dollar, obviously, on a short-term basis can have a meaningful impact on commodities. Dollar higher, obviously, means a more expensive commodity on the global market. And with respect to crude and natural gas, it's denominated in dollars. But at least at this point, with a healthy economy and strong underlying demand, geopolitical risks, we could easily see crude and natural gas prices trade higher, even with a high U.S. dollar, the other currencies.
Even if the dollar were to start to play catch up in terms of what we've been seeing as rates here, maybe it wouldn't provide the headwind that one would think here, considering the fundamental lift that we're getting. Ben, appreciate you joining us here. A solid look here. We're talking commodities and energy products here. A very busy week that was, and as we gear up for next week as well, with Ben Cook joining us this morning, portfolio manager from Hennessy BP Energy Transition Fund.